Welcome to the Universal Accounting Center's Advancing Your Accountability with your accounting instructor, Alan Bostrom. In Session 7, Construction Accounting, you'll learn why accounting for a construction business is handled differently than regular accounting. You'll learn about the jobs in progress and progress billings accounts. You'll also master several cost and profit calculations used in the construction business. And now here's Alan.
Now, construction accounting has some unique aspects to it, like manufacturing did, in that the timing between spending the money and actually making the sale or gaining the revenue could be a long time. You might remember in manufacturing we talked about when you time the sale or when you record the profits from a sale. And what does that happen again? When the goods are delivered. Now, in the event of a big remodeling job or in the event of a construction of a home or a building, the period between starting the job and when the goods get delivered could be a long time frame, could be several months long. And since we're not going to recognize the revenues or the profits from that job until that occurs, then we need to have some special accounting to account for those costs during that time. And that's where we get into what's called job costing. We're going to use two accounts that we haven't used before. All the rest of the accounts, for the most part, are the same. But these two accounts are unique to job costing. And the two accounts that we're going to refer to are, one, jobs in progress. That's going to be used the most. And then we're also going to refer to progress billings. Now, the three accounts that I've listed on the left-hand side of our sheet here, or our board, are all current asset accounts. Now, what are current asset accounts?
So that you take care of within a year?
Yeah, they're going to turn into cash within the next 12 months. So these are all hopefully going to turn into cash within the next 12 months. This one right here is called a deferred revenue account. Deferred revenue accounts are those amounts or those items that we get or bill for that we're not going to treat as revenue until some later date, okay? We might get the money, but they're not sales. They're not sales until what happens? The goods are delivered. See, when you're building a home, and let's say the cost of that home's $150,000, okay? That's what the contractor is going to pay for all the labor and all the materials and so forth that go into that. Most contractors don't have $150,000 in the bank that they can just use to spend on these things and then at the end sell it and get the 150 plus some back, whatever the profit is. Okay? So instead, they're going to make advanced billings or billings during the period of time to allow for the monies to come into the bank so they can pay all the vendors. Okay? And those are called advanced billings or progress billings. And that's where this other account's going to come in. What I'd like to do is just spend a few minutes and go through a sample, okay, of a company. And this will not be a big construction process, but more just a remodeling, maybe that might occur over 2 or 3 months before the job will be complete. On page number 6.1, we have an example 6.1 that says Joe's Brick Company, this is about halfway down the page, Joe's Brick Company spends a total of $8,000 from the company bank account on labor and materials to complete this job over a 2-month period. So we wrote checks in Joe's Brick Company for $8,000 over 2 months. Now, is it going to be a debit or credit to the bank when we write that check? Credit to the bank. Okay? Now, during this might be made up of 100 different checks. Okay? We're not talking about just one check, but a whole bunch of them. So it's a credit to the bank and it's a debit to jobs in progress for $8,000. Okay? Now this was, again, an accumulation of all of our costs during that period of construction. Sherry?
So it's kind of like an account payable.
No, because we paid the money out. Okay? Now, had we bought it on account, yeah, then we'd have accounts payable over here, wouldn't we? Okay? No, it would be a separate account, and it would treat just like regular. It would be an account over here, and as we buy it, if we buy it on time rather than writing a check, we would credit accounts payable and debit jobs in progress. Okay? This is only if we're writing the check when we pick up the goods. Okay, does that make sense to you? Now, during the period of, or during the time frame that we're doing this, the contract might allow us to collect monies in advance. For instance, when we first started, we might say, hey, I need 25% down, okay? I need a fourth of it now so I can go out and buy the materials that I need for it. And construction contracts most often allow for that when they're large contracts like that, okay? And if we bid $10,000 on that job, we might have 4 advance billings or 4 progress billings through that 2-month time frame where we're going back to the owners or the whoever's funding this thing and saying, I need another $2,500 now. Okay? So there might be 4 different advance billings. Each time we make an advance billing, there's going to be an entry to the books. And since we didn't get the cash immediately, but we just sent out an invoice, we want to record the invoice for that advance billing by debiting accounts receivable for each advance billing and crediting progress billings, our deferred revenue account. Okay? Now this is not a revenue account. In fact, it's in the liability section of the general ledger. Okay? So this is just, it's just accumulating those expected sales amount. And each month or each time we send an advance billing for $2,500, we're going to debit accounts receivable and credit progress billings. And then we're going to do it again the next time. And then we, on the last, the last day, we go with the owner and we walk around through the project to show that we've completed it. They say, hey, it's fine. So we hand them a bill for the last payment of $2,500. And when we wrote the bill, we're going to debit accounts receivable and credit progress billings. So how much have we credited during that time? $10,000, which was the amount of the bid. Do you see that? Okay. Now, as he's making payments, when he received this first bill, he gave us $2,500. Okay? What are we going to do with that $2,500? Put it in the bank. Is that going to be a debit or credit to the bank account? Debit. So we're going to put in the bank account $2,500 and we're going to reduce accounts receivable. Do you see that? Okay? During the period of this 2 months, as we're collecting advance payments, we're going to be debiting the bank and crediting accounts receivable. Okay? Now, just before we go in to the owner and say, hey, we're all done, take a look at it, looks great, they still owe us this last $2,500, don't they? Okay? When are they going to pay it to us? When they say it's done. They agree with it, right? Okay? So, those payments are coming in during this process. Progress billings recognizes that we billed them, but it doesn't recognize the sale. Now that we're done, okay, now this answers your question as far as when do we recognize the sale for it. And that's where we're going to then zero out the jobs in progress account and the progress billings account, because now we've completed it. Let me show you what this process is. When we make a sale, we impact 2 accounts. We impact the sales account, right? And we also impact the cost of sales account, correct? When we sell merchandise or materials or things like that. And where do those accounts belong in the general ledger? The sales and cost of sales. In the earnings section, right? Okay. Where was this account? In the liability section. Where are these 3 accounts? Current assets section. So we haven't yet impacted an earnings account with any of these entries, have we? Because we haven't earned the revenue. We haven't earned it until the goods are delivered. So at this last day, when we've completed the project, this is when we're going to come in and we're going to impact the sales and cost of sales account. Okay? Again, this is on the last day, or whenever the job was completed. Okay? Now, this entry is going to impact sales. How much was our sales on this job? What's that? How much? No, I'm talking about this one right here, bricks, Joe's brick. $10,000. That's what the original bid was, and that's what we did it for. So we're going to make an entry to record that sale. Are we going to debit or credit sales? Credit sales for how much? $10,000. Okay? And we're going to debit progress billings, because that's how much we've been billing them for. Okay? What's the balance now in progress billings? 0. Because it's no longer deferred revenue, is it? It's earned revenue. Okay. How much did it cost us to produce this item, this job, to do this job? $8,000 in both labor and materials. $8,000. Where's that $8,000 at right now? Jobs in progress. So we need to bring it in at cost of sales because we only made $2,000 profit on this job, didn't we? And so we're going to debit cost of sales, $8,000, and we're going to credit jobs in progress, $8,000. What's the balance in jobs in progress now? 0. Okay. Does that make sense to you? Okay. Now, why didn't we zero out accounts receivable? Right now, it shows that, I mean, that's offset, that's offset, that's offset. It still says that he owes us $2,500. What's that? He hasn't paid us yet. Okay. Now, we're all done, so we gave him the billing, and he said, well, I'll pay you now or I'll pay you next week or whenever he gave us that last $2,500. And when he gives us that last $2,500, what are we going to do? Credit accounts receivable and debit the bank account, right? Does that make sense? Now, here's the important part. Might you be working 2 or 3 or 4 or 10 different jobs at the same time? You might have a lot of projects. Joe's Brick may be having, may have some of his masons working over here and others over here and others over here. He needs to keep track of each job cost separately. Okay? So we assign each job a unique number. And we carry a subsidiary ledger on jobs in progress. And so we might have a ledger like this right here, and in it, instead of having customers' names that this one does, it will have a job name up here. And it might say job number 1, Smith Home, da-da-da-da-da, certain place, okay? And so it's going to have a subsidiary ledger that will indicate or provide a list of all the costs to a given job. He also will have a subsidiary ledger on progress billings, so he can keep track of how much was been billed out on each job. If he didn't do that, could he over or under bill a job pretty easily? So he'll have this information on that as well. And as usual, he'll also have a subsidiary ledger on accounts receivable. Okay? So we're talking about 3 separate subsidiary ledgers to support job costing in order to give us the information. Now, some construction companies need job costing a lot and others don't. Construction companies that have all their jobs are short-term, like less than 30 days. There's no need to keep track of that individual effort. I mean, for one thing, if you're going to complete it within the same month you bid it, that means you're going to record the sale that month, right? Okay? And so if you're an electrical contractor and you just go out and you install air conditioning systems at different places, well, you can do that in a day. And so job costing won't be as important to you as to that type of electrical contractor as one that goes out and installs electrical work in these big office buildings out there where it might take 2 or 3 months. Or sometimes even homes where they might do some of the electrical work now and then they come back in another month when they've gotten to a certain point and do more electrical work and maybe even a third time a month later. So those types of jobs where that job is going to take over a month from beginning to end to finish need job costing in their system. And some contractors do both. In fact, most do both, don't they? They do both short-term and long-term jobs. And in that case, some of them might be run through this job costing system, the longer-term ones, and others might be taken directly to sales.